Welcome back. We need to talk, because if you've been watching silver, you're not wrong, you're just watching the loud story, not the dangerous one. For the last few weeks we've all been locked on the same screen, vaults draining, mints tightening up, price ripping like it's got somewhere to be. And honestly, that's been the most exciting thing in finance. But while everyone's eyes were on the metal, something snapped in the bond market. Quiet, boring, the place most people ignore, right up until it starts breaking portfolios. Here's the twist. What's happening in Japan makes the silver squeeze look like a rounding error. Because Japan isn't just another country. Japan is the funding floor under the modern world. For decades, Japan was the land of near-zero rates, the place money was basically free. That cheap yen didn't stay in Tokyo. It leaked into everything: treasuries, tech stocks, real estate, crypto. The entire buy the dip era was built on the assumption that Japan stays pinned. Now look at the numbers. Japanese government bond yields are ripping across the curve. The 10-year is around 2.34%. The 20-year is near 3.47%. The 30-year is about 3.90%. And the 40-year? It's pushed through 4% to roughly 4.23%. If you're in the US, you might shrug and say, "So what? We've seen higher." That reaction is exactly why this is dangerous. Because in Japan, after 30 years of near-zero rates, a move like this isn't normal. It's an economic heart attack. And when the world's funding floor starts shaking, everything built on cheap money starts to wobble, fast. So before we talk about where silver goes next, you need to understand what just happened in Tokyo, because the timer didn't just start ticking. It hit zero. You're watching silver like it's the whole movie: vaults draining, mints tightening, price sprinting. And yeah, it's loud, it's dramatic, it's the kind of chart that hijacks your attention. But here's the problem. While everyone stared at the metal, something far bigger cracked in the part of the system that sets the price of everything. Not New York, not London, Tokyo, Japan's bond market. This is the pivot most people miss because it doesn't look like a crisis until you understand what Japan actually is. Japan isn't just another country. Japan has been the hidden foundation under modern markets, the place where money stayed nearly free for decades, quietly feeding the global machine. Cheap yen didn't just sit in Japan. It leaked into everything: stocks, tech, crypto, real estate, carry trades, like oxygen feeding a fire you forgot was burning. Now that foundation is shifting. Japanese government bond yields are rising. And that sounds boring, until you realize it's the same as turning the dial on global funding costs. This isn't a local rate story. It's a global liquidity event. It's the moment the world's cheapest funding source starts charging real rent. And when that happens, every asset that lived off easy money gets forced to prove it deserves its price. Here's the hook you should sit with. Silver might be the canary, but Japan is the blast charge under the mineshaft. The timer isn't ticking anymore, it hit zero. The shockwave has already left Tokyo. The only question is whether you'll recognize it before it hits your portfolio. And this is where the story stops being a theory and starts becoming a receipt. Because if Japan really is the anchor under global funding, you don't feel the snap first, you see it in the numbers. The bond market prints the truth in real time. And right now Japan's prints are screaming. Look across the Japanese government bond curve and the move isn't subtle. The 10-year is up around 2.34%. The 20-year is near 3.47%. The 30-year is roughly 3.90%. And the one that should make you sit up straight, the ultra-long 40-year, has pushed above the psychological 4% line to about 4.23%. If you're American, you might shrug. We've seen higher. That reaction is the trap. The script isn't asking you to judge Japan by US standards. It's asking you to judge Japan by Japan's operating system. For roughly 30 years, Japan lived in a near-zero rate reality. Their entire financial ecosystem, government budgets, bank balance sheets, pension assumptions, and the free yen that fed global trades, was built on the idea that rates stay pinned to the floor. So when yields jump like this, it's not normalization, it's a heart monitor flatlining. Because yields don't rise alone, bond prices fall. And the losses aren't theoretical. They hit balance sheets. Then comes the second punch, Japan carries a massive debt load. And higher yields turn debt service into a compounding problem. A few percentage points don't sound dramatic, until you realize they can triple or quadruple the cost of keeping the system alive. Here's the hook. What looks ordinary on your screen might be fatal in Tokyo, and if Tokyo breaks, it doesn't stay in Tokyo. So now you know the numbers aren't noise. They're a warning light, but the real question isn't whether Japan's yields are rising, it's what happens when the world's quietest whale changes direction. Because Japan isn't just a country with a bond problem. Japan is a creditor, a net exporter of capital. The rich uncle of global markets who's been writing checks for decades while everyone else ran deficits. For years, Japanese savers and giant institutions had a simple problem at home. Yields were pinned near zero. So they did what rational capital always does, they went shopping overseas. US Treasuries, European bonds, big US equities. The point isn't the ticker symbols. The point is the role Japan played, a foundational buyer. A steady hand that helped keep global funding cheap and global asset prices supported. But when yields at home jump, the entire incentive structure flips. Suddenly, Japan can earn real returns in yen, on domestic bonds, without taking the currency risk of dollars or euros. That one change sounds technical, but it's the kind of technicality that moves trillions. The script calls it what it feels like in the plumbing. A giant sucking sound. Liquidity being pulled out of global markets and dragged back to Tokyo. This is the Great Repatriation, and it's not a headline event. It's a flow, a slow, structural reversal of the river that fed Wall Street for years. Money that used to leave Japan to buoy global assets starts coming home. And when a foundational buyer becomes a reluctant seller, or even just stops buying, the market doesn't need panic to fall. It only needs absence. Here's the hook. You don't get a warning email when the whale turns around. You just notice the tide disappearing, right before the beach gets exposed. And this is where the Great Repatriation stops sounding like a flowchart and starts acting like a weapon. Because when Japan pulls capital home, it doesn't just change who buys what. It changes the price of the one ingredient that powered the entire last cycle. Cheap leverage. The river reversing is bad, but the real danger is what happens to everyone who built their portfolio on the assumption that the river never reverses. Enter the yen carry trade, the most important trade most people never talk about. For years, funds could borrow yen at almost nothing, convert it, and buy everything that went up: big tech, crypto, real estate, anything with momentum and liquidity. It wasn't genius, it was math. When your funding cost is near zero, you don't need perfect picks, you need exposure. And Japan, quietly, was the world's cheapest fuel pump. Now the pump is shutting off. Rising Japanese yields don't just raise rates, they pressure the yen. And as the yen strengthens, the carry trade turns into a margin trap. Here's the brutal mechanic. If you borrowed yen, you owe yen. If the yen gets more expensive, your debt gets heavier even if your assets don't move. So what do leverage players do when the debt swells and funding costs rise? They unwind. And unwind doesn't mean rebalance. It means sell. Sell the assets you bought with borrowed money to pay back the loan. That's why the volatility doesn't look like a clean crash. It looks like persistent, contagious tremors, because this selling isn't emotional. It's structural. It's forced. The script's claim is simple and terrifying. Japan's rate shock is the pin that pops the everything bubble, built on cheap money. And once forced selling starts, it doesn't ask permission from your calendar or your convictions. Forced selling is the spark. But here's the part that turns sparks into a controlled burn: the whales. Because once the yen carry trade starts to unwind, you don't just get hedge funds tapping out. You get institutions doing something they almost never do. Selling not because they want to, but because they must. Remember what rising yields really mean. Bond prices fall. And Japan is stuffed with bonds. When domestic JGB portfolios take hits, balance sheets develop holes. Those holes don't stay on paper when you're a pension fund or an insurer with monthly liabilities. Retirees still get paid. Claims still get honored. So cash has to come from somewhere. And the easiest place to raise it is the most liquid pile of winners: US equities. That's why the script drops the number that should make your stomach tighten. Roughly $500 billion in potential US stock trimming. Not retail. Not day traders. Not weak hands. The whales, major Japanese pensions and insurers, sitting on enormous positions in the same mega-cap names that dominate your index funds and your retirement account. And here's the twist that makes this scarier than a crash. It's not framed as a one-day event.